Testing, 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 testing. I'm David Wilton. I'm the Chief Investment Officer of Oister. So, two reasons that a quality diligence is important. One is just the huge spreads between the top and bottom performers. The gap's much, much bigger than it is in public markets. And so you need good diligence to identify those who are going to give you the better return. And the other is that in private markets, unlike public markets, you can build a franchise that can provide consistently better returns. And for that reason, it really pays to do the diligence to identify the GPs who can do that. Well, firstly, just the logic, the reason you want to do it, is that the only way you construct a really top-rate portfolio is by identifying all the potential opportunities. The worst thing you can do, one of the worst things you can do in private equity, is just sit and wait for GPs to come to you and just evaluate the ones that you see. So you'll never get the full set. So just for optimal portfolio construction, you need to know the full set you're dealing with. Going about it is really difficult because there's no clear database that gives you the answer of who's out there. If we look at the SEBI registrations with AIFs, we can see who's registered in AIF. That doesn't tell us how many funds are inside that AIF. We get reports from different market sources like Traction and so on. That lists a whole bunch of funds, but it's very hard to link that back to the GPs. So firstly, just getting a good estimate is difficult. But then once you've got that, you're faced with at least 600 potential GPs to go and diligence. How do you have the time to diligence 600 GPs? So this is where Oister, you have to be local. I mean, when I was running the IFC portfolio, key thing was you had to have people in the field local to understand the local scene. And obviously Oister is. So you can use your local knowledge, your contacts, your networks to initially say, well, out of this list of 600 names, who has a good reputation? Where's a good place to start? It goes back to the logic of, I guess the foundational logic of our diligence is to understand which GPs have a competitive advantage. And for that, you need to analyze their franchise. And by franchise, I mean three things. How good is their sourcing? Do they have any competitive advantage in sourcing? Basically, can they win deals based on non-price factors rather than just having a bidding war and winning on price, which frankly any fool can do. And there's other reasons why you want non-price to win. And then looking at the quality of the value addition, how they help either the founders or if it's private equity, the companies to grow, to increase in value. And then exits. How well do they plan exits? How do they structure that? And in each of those areas, in sourcing, value addition, and exit, you can get a reputation for being better than other people. If you've got a reputation for being very good at value addition, you'll attract a lot more potential entrepreneurs. Your deal flow improves. If you get a reputation for having strong value addition and being good at exits, a lot of companies or managers of funds further up the feeding chain will come to you to see what you've got because you've got a reputation for creating good companies. So your ability to exit improves. So you build a stronger and stronger franchise. And that gives you a competitive advantage over your rivals, which then means you can probably produce, on average, a better return over time than other people. So, long answer to what was a more simple question, but because that's the way you focus on diligence, you don't get the information you need to understand their ability to source, their ability to add value, their ability to exit, until at least they've been through that cycle, which they normally don't get to until the end of Fund 2, beginning of Fund 3. So that's why the focus is on Fund 3. Now, the exception to that is a group of founders of a private equity group or a VC group who are spinning out of well-reputed, credentialed, existing firms with attributable track record. And if that's the case, we'll back them. And the reason for that is partly they've been trained in good places, they've got a good personal track record, and then the data from the US indicates that that profile of person in their first fund is incredibly motivated to show that they can make it. And that motivation gets you across the line and produces a good result. The reason we look at the quartiles is that unlike public equity, private equity, each fund starts at a certain time and it runs through its process of sourcing, adding value and exiting over a certain time period. And each of these time periods is different. So a fund starting in 2014 is going to encounter a different time period to someone starting in 2015, 2016 and so on. So you don't want to judge funds based on the absolute return. So if I get two funds, both of them have got 20% net IRR, so one's got 22%, one's got 18%. I don't automatically say the 18% guy is clearly worse than the 22% guy. I need to look at the vintage year comparison. So how do they perform against their peers who launched their funds in the same vintage years? And if it turns out that the 18% guy is in the top quartile for his vintage year, because the average for that vintage year was only 10%, whereas the 22% guy is in the third quartile for his vintage year, because the average for that vintage year was 26%, the 18% guy is a better GP, is a stronger GP and a better bet over time. So the reason we look at quartiles, I guess to sum up, is that you want to compare performance in these private markets against the performance of the vintage year peers, not on some sort of absolute return basis. Otherwise you'll get misled. And then the way we do it, SEBI has very sensibly wanted to create benchmarks for the market. And so they've asked people to, I guess, get a license to create these benchmarks, and CRISIL is one of them. I think Preqin has one, somebody else has one. Eventually it means that the Indian market is going to be more transparent than any of the other markets and better benchmark. There's two parts to that. I mean, it's all very well someone having a great performance, and we check out the quartiles, we check out a bunch of other stuff. But then once we've convinced that historically they're good, how do you know they're going to continue to be good? And so it's in two parts. One is the analysis of the franchise and the strength of the franchise, which we've discussed earlier. But there's just a preliminary set of basic data steps that we go through just to see if there's basically looking for any events that might have happened which would invalidate the prior track record. So, for example, have they lost any key staff? Is the compensation structure, the incentive structure inside the private equity firm conducive to everybody staying and being aligned, or will it eventually lead to a risk of the team splitting up and blowing up? Have they explicitly changed their strategy? Or have they implicitly changed their strategy by raising much bigger funds and then, with the larger sum of money, migrating to a different deal space? So those are just some of the things we check to make sure that there's been no event that's happened that would invalidate their prior track record. Part of checking that they can repeat their returns is the strength of the franchise. And that is the core of the analysis. I mean, most of the rest of the diligence process is just very structured and focused, and you do it in a very orderly manner so you don't lose focus. But it's getting data and checking, getting data and checking, getting data and checking. When it comes to the analysis of the franchise, that's a little more qualitative. And what you're looking for is, do they have a competitive advantage in sourcing, a competitive advantage in adding value, and a competitive advantage in exiting? So, for example, in sourcing, you want a GP to be winning deals based on non-price factors. And the reason you want that, firstly, if they're just winning a bidding war, possibly they're paying too much. But the other more subtle reason is that as a venture capital or private equity guy, if I win a bidding war, then really the founder of the company doesn't want me for my skills, what value add. He just wants the money. And so once I've actually invested, my ability to influence what happens to that company is really not going to be very big. So we want to see people who've developed ways of sourcing that enable them to win a lot based on non-price factors. Then when it comes to the value addition changes based on the stage that they're investing at. So in the venture capital stages, which are sort of pre-seed through to sort of B roundabout, there are changes about B to C, but around B, it's all about the founder. So you need to be supporting the founder, helping the founder, help the company make network connections, helping bring in clients, but a lot of it is being a good sounding board for the founder. It's that the founder is sort of central. But when you shift to private equity, much later stage stuff, mature companies, it's all about the company and analysing the company to see this is what we're buying now, this is what we can sell in the M&A market or the public market. How do we get this thing to that? And building a dashboard of controls to drive it there. And if it turns out that the relevant skill set's the most important thing to get from here to here is not the main skill set of the founder, then you've got to find something else for the founder to do. So it's not so founder-centric at all. And we just need to sort of check that the value addition approach, one of the things we do is check that actually suits the stage. So it's all very well looking at the quartile stuff and saying, wow, this guy's hot. But then you need to look at inside the portfolio, all the companies, and what the distribution of MOIC is, multiple of invested capital. And you do that for two reasons. Firstly, you want to make sure that fantastic track record is not just based on one or two lucky moonshots, which you really can't repeat, because we're looking for things that can repeat, or at least you can't guarantee repetition, but things that have a reasonable chance of repeating. So things based on a couple of moonshots, nah, probably not. But the other reason you do it is that in each of these different stages, the loss ratio, there's a different loss ratio that's acceptable. And so if you're doing early stage stuff, 60% write-offs in the portfolio is fine. No one's going to get upset. If you had 60% loss ratio in private equity, it would be a disaster. So the other thing we're looking for is just checking that the loss ratio is appropriate to the stage of investment. Really, we just want to make sure that the terms of the fund are within market standard. We're not going to go getting aggressive and trying to push the GP into something unreasonable. On the other hand, we're not going to accept anything that's unreasonable. So just both the financial terms and the governance terms. So just for example, on the governance side, you'd want to see a limited partners advisory committee only made up of LPs. There weren't any friends and family of the GP on the LP, for example.